Think of the Eurozone's central bankers as caryatid columns on whose heads rests the roof that is sheltering Europe's investors. Spain's failure to elect a clear victor in this weekend's election was, for markets, the worst possible outcome. Fractured politics carry the threat of undoing economic reforms that investors in Europe's southern periphery are so keen on. Job creation in Spain is positive and the economy is one of the fastest growing in Europe, but with debt still rising and unemployment close to 22%, the foundations are shaky. Scan stock and bond prices, however, and the reaction to Sunday's vote appears mild. The difference between the yield on Spanish 10-year bonds and those of Germany is just 9 basis points wider than it was before the election, and it's nowhere near a year high. Equities fell a few points, but the euro lifted only slightly. For investors, elections in Europe this year and the rise of anti-austerity politics have offered lots of opportunity for political commentary, but not much price action, thanks in no small part to the numbing properties of the ECB's 60 billion per month QE programme. So what happens in 2016? The ECB may expand QE further, but the US decision to raise interest rates last week has drawn a line underneath years of global monetary easing. So is too much good news priced into bonds issued by the Eurozone's peripheral countries? Europe's debt to GDP levels are now worse than they were during the Eurozone crisis, and 6 Eurozone countries carried debt burdens larger than their annual economic output, including Italy, the region's third largest economy. The debt to GDP ratio in Spain is also just shy of 100%. Global low bond yields have been a boon, keeping the cost of servicing that debt ultra low. To maintain sustainability now, Europe's peripheral countries need growth. And while Spain is growing, Italy has only just pulled itself out of recession. That means Italy could be the Eurozone bond market to watch out for in 2016.